You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Richard Knowles, financial consultant and wealth manager from Knowles & Associates in Vancouver. Welcome to the show, Richard.
Yeah, thanks for having me, Jim.
The Bank of Canada, I guess, is cautiously optimistic about the Canadian economy. Stephen Poloz, the governor of the Bank of Canada, says despite a low dollar, high meat prices, and higher telecommunication costs, he still thinks the Canadian economy will have room to grow, and that oil prices being down, is a stumbling block. But his point of view is increasing employment in the U.S. is going to increase Canadian exports, and that's what's going to carry our economy into the future. What's your position on this?
Well, it certainly has some validity. There are some numbers that are on the table that seem to support his beliefs, and as an economist, that's what he's giving. There's two sides to every story, of course. In the one case, in each of his statements, for example, he expects that the economic growth of job growth and creation in the United States will help to carry Canada's growth into the future. Is based on a premise of what kind of job growth that is. In the past, 20 years ago, or, even 15 years ago, job growth could have been massive, excellent job growth in the middle management and upper management areas, good paying jobs, technology was booming, etc. These new sectors were opening up. Healthcare in the U.S. Was growing more and more all the time, even though questionably a good system or not. Regardless, there was jobs being created in quality type jobs, sales jobs, etc. However, today's job growth you'll see in the U.S. as being primarily in areas of low economic wage development, Walmart employees on minimum wage, and even most of the job growth that we're seeing in the U.S. is being driven not by high caliber employment, but really lower caliber employment. Now, that's not to say that high caliber employment isn't expanding to some degree in certain areas, but I mean the greatest emphasis of job growth creation is not in these high developed areas or in some new developing economy or economic business. So therefore, can we count on that kind of job growth to really stimulate expenses and spending? The reality is, I don't believe it is. I don't believe that will indeed spell out great economic growth for us as a nation in Canada to feed this massive economic giant of the U.S. In fact, I see it as more of a treading water approach. They seem to feel, Poloz and I suppose his statisticians seem to think that it's going to be the same old, same old. I disagree with him, respectfully. I think that what is happening is the job development. And I can say that my opinion, by the way, is a developed opinion reflecting a lot of learned opinions in the industry. It's not just my own, trust me. A lot of people, very well-known multi-billionaires, etc., and well-known pundits like Warren Buffett and others seem to agree that the mass of job creation is not in the some new high technology business that's coming out, which is going to expand like we had in the technology boom of the late 1990s. It's really just same old types of old school businesses developing lower wage structures so that more profits go into dividends for the companies and the shareholders can profit. And that formula has been very consistent. It's nothing new. We've had this a long time. And now we're meeting and greeting our own sort of fate, if you like. There are some new developing technologies. We can see things in areas of fuel development, energy development outside of oil and outside of these other some more coal and other more static and old school types of energies. However, if you look at the world today, and certainly Canada is not unlike a heroin addict. We have our own black heroin, so to speak. It's called oil. And our economy is really so deeply ingrained, and the current government is so supportive of making most of its tax revenue from selling oil, that a drop in oil prices today is not spelling very good news for us as an economy. Further to that, our own government has a bias, clearly does have a bias, certainly is true in Alberta, where it's an oil nation, oil province, I should say, and our nation has become an oil nation. And this addiction, so to speak, to this type of heroin is very deep. We cannot just suddenly turn around and ask our government to support all sorts of alternative energies the way the Germans do, for example. Germany has weaned itself off of nuclear energy and other sources of energy by going solar. And its brilliance should be reflected around the world. However, when most of your money is being made by selling a different type of energy, the way we have in Canada, the reality is we have no particular emphasis, if you will, to try and sell that type of new product unless we can also profit as much as we can from that. So I think the future does hold a lot of promise. However, we're going to have to take a little bit of painful medication in the short term to realize that we're probably going to go into a recession in 2015. If at best hold on to what we've got, I don't see a much massive growing economy in this next year. I'm carefully concerned about equities having a correction. I think it's a global issue. We have a lot of geopolitical problems that are just still fomenting. We have, of course, the Russian crisis, and they have a winter to get through with low oil prices. As an oil nation, they're going to be suffering terribly, and they're already stating they're in a recession, and will officially be so probably by the early year. We have a slowing economy in Canada due to oil pricing as well. We have global slowdowns which have not been rectified. Now that's the negative side, and I think there are lots of positives, agreed, but not as many as negatives, and I think we have to come to our own conclusions as to what this is going to spell for us looking forward as Canadians, what our economy will be structured like. Is it very hopeful? Is there nothing but great news coming around the corner? No, I think we have to agree that's not the case. Our dollar is lower, which is good actually. At least to a certain degree it's good for us. It's not great if we're traveling and importing a lot of things, but we are an export nation. We have to always realize that. You're a Canadian. Welcome to the world. You know, if you're a baby, you didn't know this. If you're an adult, you should. And that's the fact that we're an export nation. We rely on exporting our goods. That's how we make money. And if we overprice, if it costs too much to buy our goods, you know, our neighbors to the south and the Chinese, they're going to go someplace else. We cannot afford to have a high dollar. Get over it. It's not a good thing for Canadians. I mean, a nice dollar somewhere in the 89 range is pretty healthy for us right now. It's not too affordable. It might cost us 10% more to go to the States, but you know what? It's cheaper there anyway. So it's a kind of a break even. It's not so bad. And in fact, we can sell more goods. They continue to buy our stuff. And as long as we can be close to our trading partner, we always have to remember who our clients are.
And a lower Canadian dollar also increases tourism.
Oh, absolutely. I mean, the tourist trade couldn't be happier with a lower Canadian dollar. It floods our markets with people from all over the world. If anyone recalls what it was like when the dollar dipped, although it was temporarily down to around 60 cents, that was scary. It appeared scary to Canadians, thinking, oh my gosh, I can't leave the country. It's going to cost me double pretty much wherever I go. But the reality was a lot of currencies followed us down too. It was really only against the U.S. that was really struggling as much. And, you know, to be honest, we had more American tourists in our country. Our hotels were completely stacked full. All the tourist areas were making tons of money. Our economic fishing, all the fishing lodges and everything, they were full. People traveled to the cheapest place to go. And if it's a good established country like Canada, there's always a bright shining star to a lower dollar, and there are some shining stars to a higher dollar. But if you put a line down the page and you look at all the pros and cons of a higher dollar versus a lower dollar, as an economy, as a Canadian, if you're looking at the big picture, not just individually as a guy that wants to be a senior traveling the world, right, then you're despondent because you can't go places too expensive. But that's a very small percentage of the big picture of the demographic of Canada, to be fair. And if you're looking at it as a Canadian for our own economy, yeah, you might have to travel inside Canada that year a lot more, but in the end, it might cost you a little bit more to buy goods, of course, that we're importing. Certain foods from the States or Mexico or something might cost more. But, you know, we can get around that. You know, there are goods that we can buy to replace that, or it could be a small cost for a period of time. We just don't want to stay there. You know, it's just too low as 60 cents and too high as a buck, really. To be on par with the U.S., it's too high.
Richard?
So there's a fair number somewhere in there.
Yes, I was going to ask too, with crude oil prices down and stock prices for major energy companies down, would this be a good opportunity for people to invest in the solid companies that you know aren't going to go away because their prices are down right now?
Yeah, the only, if you were looking to energy at this time, and you were looking to buy, for example, if you're looking to buy into oil stocks or oil company stocks, you'd have to be with the biggest players. The problem with having too low an oil price is that the small players cannot afford to go to work. They literally cannot afford to drill because they don't have the economies of scale to have production coming in, just regular oil production coming from existing wells, to be able to finance new oil well development. It is a good time to be looking at some of the biggest blue chips in the oil environment that are coming out of Canada. I advise anyone to, look into that. But again, always remember that any form of investment should be relegated to your portfolio plan. And your portfolio plan should already have been set long before you start talking about any investments. In other words, you've allocated a certain percentage to, for example, energy and financials, a certain percentage towards financials, a certain percentage towards consumer, a certain percentage in Canada, a certain percentage outside of Canada, etc. Plus, you can start to look within the structure of your energy sector's portion and see if it's valid to up it at this time or maybe sell it out. Take your profits, if there is any left after this correction. So really, averaging down, and probably your energy sector portion of your portfolio has decreased because of this correction, and this would give you an opportunity to sell some of your higher investments, higher valued investments, and average into your energy sector. But always stay with the highest quality, because energy relies on big dollars to keep it going in whatever resource it's getting, like gold, silver, whatever it is. There's a certain price point for every resource, that if it goes below that, the small players really suffer because they can't afford to actually take their own reserves out of the ground. It costs too much. Whereas the big players are the safest bets during these pullbacks in prices.
We'll have more with Richard Knowles right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Richard Knowles of Knowles & Associates. Richard, I have a pretty big question here. Is your tax-free savings account actually going to be tax-free?
Well, there's always interpretations with every new plan that comes into being. RSPs, when they first started, there was a jostling period. There's always an establishment of the rules period. Anytime there's tax credits or tax write-offs, like the RESPs, remember your education savings plans? They were started a couple of handful of years ago now, but reasonably recently. And their first few years where they were getting established, even actually as late as last year, there were rules being changed and new things were jostling around and documentation was being changed. It's been there's always the headaches, what I call the startup headaches of any new tax plan. And TFSA is no different from any of the rest of them. What we've got now, the tax-free savings account, I should point out to your listeners that the tax-free savings account is really just a complementary account investment that you can do, where you have tax-free investments. The money that goes in is already after-tax money, but all the money it makes is tax-free, and you can take the money out later. That's the concept. It's not a new concept. It's a new concept to Canada, but it's not a new concept. It's been done in the U.S. for a long time. They actually have much higher maximums. I think it's up to $25,000 a year that they can put into their accounts, similar accounts. And you have international accounts like this as well in different countries. So we are really just catching up in Canada to some of these ideas. That's very nice. I applauded it tremendously with this idea. I thought that the amounts were too low, but relatively speaking, they were just getting going, and they've already increased it once. Started at $5,000 per year per Canadian, and now it's up to $5,500 per year, and with a rollover. So if you missed it this last year, if you've missed it since 2009 when it was implemented, you can add it all up and do it all in 1 year. There are certain rules that go with withdrawing, but otherwise it's all pretty much straightforward. At least appeared so until pretty much yesterday. Yesterday, the CRA acknowledged in an email response to a legal firm requesting some more information that is now currently taking an, quote, a closer look, unquote, at a very small percentage of accounts in the TFSA accounts area. In fact, they stated, and I quote them, less than 0.0001% of all TFSAs, unquote. And the reason they're doing this, they state, is to make sure that the TFSA itself complies with the spirit of the legislation. Now, I want to point out that whenever I hear the word spirit of the legislation, I suddenly balk. I immediately balk, because that means that there's a gray area. It's just literally like, if you like, you're looking at the way to measure, the skating championships, and you have a bunch of people giving 0 to 10 based on the interpretation that they're watching, rather than a field jump where you can just literally measure the distance. And if they win based on the distance, there's no argument. It's not an interpretation. It's none of that. There's no spirit to the interpretation. It's literally a measurement. Now, the TFSA started out being a measurement. In other words, you put money in, you take money out, it's tax-free. There was no spirit involvement. They said, these are the things that qualify as investments, go for it. Now, the reason they're looking at this is there's a number of people that have actually been in the news. A couple of brokers did this. They took some big plays. They opened a stock brokerage account with their TFSA, which is fine, you can do that. And you can invest in many different types of stocks. And they did. And they happened to win big. So while they've only invested up to $30,000, they now have over $500,000 and more in investment value in their TFSA. Because they made so much money that is not now taxable, if you stick with the TFSA rules, that's fine. That's good for them. If they wish to take the risk, they could have lost all their money. They took a risk and they made this money. They should be applauded. It's a very small percentage of the money that's out there. Using CCRA's own words, the Revenue Canada's own words, they should ignore this. It's too small a percentage to be concerned about. Let the rules lay where they are. But by looking at them, they're telling us, they're giving us a signal. They're not even aware of it. It's a psychological signal. And what it is they're telling us right up front, we don't like you making a lot of money in this. If we're not going to get taxes, even though it's only 0.0001% of the TFSAs that are currently able to do this, that we're questioning, we're still going to look at it. Because even if we don't think it's going to go big, we want the opportunity to claw back money. So what we're looking at is a threat to a clawback on a tax privilege. Now, there's no right of law that says we have a right to have a TFSA. In Canada, there's no right of law that states that we shouldn't be taxed, although in theory we shouldn't be at all, but we comply with the federal tax rules.
Well, don't forget, Richard, income tax was brought in 1917 to pay for the First World War and only hit the 5% top earners. Well, I guess we're still paying for the First World War.
Well, it's the same argument that when the Liberals came in at one point with their Red Book, they stated they were going to scrap the GST because it was illegitimately brought in by Mulroney under the Conservatives. And everybody voted the Liberals in, but after they got in, they said, well, we looked at the GST and the money's really good, so we're going to keep it. So that's exactly what the tax people have done. Revenue Canada, while has a federal law statute that it can arrest you and put you in jail for not paying your taxes if indeed they wish to, if they wish to impose that. So this is a very big questionable issue. Everyone that ever has invested in an RSP often criticizes it by saying, not that you're getting money back from the government. That's great. That's the big incentive for, say, a regular RRSP, not TFSA, but an RRSP. One of the biggest benefits is getting your money back. But one of the biggest drawbacks is now you're hooked into a system which is registered and monitored on your money with the federal government, that when that money comes back out, the financial institution, whomever they're with, has to withhold taxes on behalf of the government and pays that for you, and you don't have freedom of access to your money. It's not privately yours. It's in effect being monitored. And this is where a lot of people feel offended, that they're locked into a tax agreement with the government, whereas the TFSA was the first introduction of a non-tax agreement, if you will. But even though they're saying, listen, here you go, we're going to ignore all this, go for it. The only registration, yes, you're going to be registered somewhere to monitor that money, but we're not involved. That's the theory. That the financial institutions would look at it and go, okay, it's a TFSA. As long as it's meeting the guidelines, and we'll report that your accounts are meeting the guidelines, the government's never going to know about it. Well, they heard about all this big money being made, and now they're coming back in, and they're putting their nose back in their business. And that's the threat. It's not that 0.0001% of the accounts are going to affect a lot of Canadians. It's that the fact that they're taking attention to review the spirit of the legislation under this example of such a small incremental amount of money means that they are desperately seeking a method of opening a precedent to be able to look at TFSAs in the future and either maybe have a clawback, who knows. The implications are clear that they're saying, well, it's a tax-free account for now. And as long as you don't make too much money, we're okay with it. But they don't have that same rule with RSPs. This person could have had an RSP and made billions of dollars in it. But that is good for Canada. That's what Tax Revenue Canada would tell you, is that they say, well, that's okay, because when they take the money out of the RSP, that's when Revenue Canada gets their big cut. So there's an incentive for Revenue Canada for you to make a lot of money in an RSP. They're happy for you to do that. But there's not a great incentive for them for you to make a ton of money in your TFSA. And so what I probably foresee isn't so much that they're going to stick their nose and try and do clawbacks as much as they will change the rules of what you can invest in. And they could easily do that by saying, well, you're allowed to invest in a TFSA with only conservative investments, similar to a trust account, where you can't get into small penny stocks, or you've got to close down venture capital corporations or whatever, something that could make you a ton of money overnight, 10,000%. Numbers, while you could lose your money too, but they're going to prevent the higher volatile opportunities and trading. Maybe they're going to limit trading. Like this person was a day trader and he just happened to do a lot of money, took a lot of risks, and he made good money.
And Richard, of course, they're going to use the excuse, we're trying to protect people from risky investments. That's the angle they're going to take in the guise of protecting, but really we know it's just another tax grab.
Oh, it's Big Brother, for sure. It's Big Brother. We're doing it for you. We're patting you on the head. We know better. And it's insulting. It's very demeaning, and it's very insulting. For the people that don't know what they're doing, generally Canadians are pretty sensible. They don't do it. The people that take risks are the ones that they know that they can take the risk. And only an idiot takes a risk when they know better, I mean, you can't convince me to take a risk on something unless I'm being lied to by someone saying, oh, you can jump out of this airplane without a parachute. It's done all the time. Well, if I'm quite that silly or
they just don't tell you what happens when you land.
I deserve to die. I will accept that willingly. My gene pool should end right about now. But I'm sorry to say that. But the reality is, if you don't know, you shouldn't have been in the plane to begin with, right? So that's common. That's what we call common sense. But we all know common sense is less common today. At the end of the day, we have to be very careful when we see implications of this nature on anything. But the TFSA, as I said, is in its growing phases. It's in its growing pains. And it is an opportunity given to us, you see. It's not a rite of passage. It's not like the government's going, we're out of it. They're very deeply into it. If it's not for them sanctioning the TFSA, we have to pay income tax no matter what on everything we invest in some way, shape, and form. So we have to follow these tax rules, and everything we do when it comes to investing, unless you're in a tax-free environment, for those people that want to get out of this nightmare, you've got to move to Turks and Caicos. You've got to move to Jersey. You've got to move to Bahamas. You've got to get out of this country. You have to become a non-resident of this country and become a legal resident of a tax-free country in this planet. And your investments and everything else will become invisible. Government doesn't care, doesn't want to know. They have no interest. You pay sales taxes perhaps where you go or whatever, and they'll get that when you buy things.
Richard, thanks a lot for chatting with us.
My pleasure, Jim, always.
My guest has been Richard Knowles of Knowles & Associates in Vancouver. If you have any questions for Richard, you can send them to Richard K, that's the letter K, Richard K at CustomPlanFinancial.com. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. We're also available on YouTube channel Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.